Welcome to this in-depth book review and audiobook-style breakdown of The Psychology of Money by Morgan Housel. This book is not just a guide to money. It is a guide to human behavior. It shows us that financial success is rarely about knowledge. It is about habits, patience, emotions, and perspective. The Psychology of Money is filled with timeless lessons and engaging stories. In this extended review, I will not only explain its main principles, but also share real-life examples from history, business, and everyday life. These examples will help you see how Housel's insights apply in the real world. Let us begin. Money is never just about money. It is about behavior. Consider two people with the same salary. One saves and invests, while the other spends everything. Their results are completely different. The difference lies not in math, but in choices and emotions. One of the most striking lessons is about luck and risk. Bill Gates attended one of the very few high schools in the world that had a computer in the 1960s. Without that lucky break, Gates might not have had the same path. On the other hand, take the story of Ken Evans, Gates's close friend, who was equally brilliant but tragically died in a mountaineering accident as a teenager. Same talent, same opportunities, but risk ended one life while luck fueled another. This shows us two things. First, we should be humble about success. It is not just hard work. It is also timing and circumstances. Second, we should be kind when we see others fail. Risk plays a role in every story. There is also the lesson of knowing when enough is enough. At a wealthy man's party, a guest compared himself to the billionaire host. The host had billions of dollars. The guest had far less. But the guest smiled and said, "I have something he will never have. Enough." History is full of people who did not know when to stop. During the 2008 financial crisis, investment bankers who were already worth millions kept chasing more. They took reckless bets. When the housing market collapsed, they lost everything. They had wealth, but no definition of enough. Now let us talk about compounding. Warren Buffett's net worth today is measured in the hundreds of billions. But most of that wealth came after his mid-60s. If Buffett had started investing at 30, instead of as a child, his wealth would be impressive but nowhere near the same. His success is not just about skill. It is about time. Compounding is powerful, but it requires patience. Consider an oak tree. It takes years before it looks impressive, but then it grows strong and towering. Money works the same way. But many people interrupt the process. They buy high and sell low, chasing quick profits instead of long-term growth. Another insight from the book is that true wealth is freedom. Many people imagine wealth as cars, houses, or luxury. But the greatest benefit of money is control over your time. The freedom to spend your day as you choose. The ability to say no. That is worth more than material possessions. Think about people who earn high salaries but are trapped in jobs they hate. They might look rich, but they are not free. Contrast that with someone who earns less but has no debt, a savings cushion, and the flexibility to walk away from work they dislike. Which one is wealthier? Let us move to stories about financial behavior. In the late 1990s, during the dot-com bubble, investors poured money into internet startups with no profits and no business models. Why? Because the story was so compelling. The internet was going to change the world. And it did. But many of those companies collapsed, wiping out billions. This teaches us that people do not invest in numbers. They invest in stories. When stories are powerful, they override logic. A similar story unfolded in the mid-2000s with housing. The belief was that housing prices could never fall. People bought second and third homes on borrowed money. Banks lent recklessly. When the bubble burst in 2008, the financial world collapsed. The lesson is clear. Be careful with stories. they seduce us into ignoring risk. Another point Housel makes is the importance of saving. It sounds simple, but saving gives you flexibility. Consider people who had savings during the pandemic in 2020. They could stay calm, pay their bills, and even invest when markets dropped. Others, who had no savings, were forced into panic decisions. Saving is not just about money. It is about peace of mind. It is about options. It is about control. There is also a critical distinction between being rational and being reasonable. A rational investor might put every penny into the stock market. After all, the math shows that long-term, markets rise. But what happens when the market crashes? That same person might panic and sell at the worst possible time. A reasonable investor, however, balances. They keep cash for emergencies, even though cash loses value to inflation. They diversify, even if one investment could outperform others. Why? Because the reasonable plan is the one they can stick with. A rational plan that you abandon is worse than a reasonable plan you follow for life. Another story Housel shares is about the variety of financial experiences. For example, someone who grew up during the Great Depression will see risk differently than someone who grew up during decades of growth. A person who lived through hyperinflation in another country will fear currency collapse more than someone who never experienced it. This explains why people disagree so strongly about money. We are not just looking at data. We are looking through the lens of our own life stories. Another vital lesson is about staying wealthy. Getting rich is one skill. Staying rich is another. Many lottery winners become broke within years. Athletes who earn millions in their careers often file for bankruptcy after retirement. Why? Because staying wealthy requires humility and caution. You must avoid the big mistakes, reckless spending, heavy debt, or risky bets. Wealth is preserved not by genius, but by consistency. Take Warren Buffett again. He has never tried to double his money overnight. Instead, he avoids big losses, makes reasonable decisions, and lets time do the heavy lifting. This brings us to a final reflection. Money is not about spreadsheets. It is about psychology. It is about behavior. It is about patience. It is about knowing what enough means. It is about valuing freedom over luxury. It is about saving for peace of mind. It is about being reasonable instead of perfectly rational. It is about understanding luck and risk. The Psychology of Money is not a book about how to beat the market. It is about how to avoid beating yourself. When you look back at financial history, the people who succeeded were not always the smartest. They were the ones who stayed calm, stayed consistent, and stayed humble. Thank you for listening to this extended review of The Psychology of Money by Morgan Housel. If you enjoyed it, make sure to subscribe for more audiobook-style reviews of the world's greatest books on money, habits, and human behavior.